Hey everyone, I'm so excited. Today I'm going to show you how you can save between $100 to $500 every single month on your mortgage payment. And I've got the amazing James Looney here from Process Mortgage. I always want to call him James Looney, not because he's loony, but that's how it's spelled. So how do we remember that it's Looney?
All right, Chantel, that's the easiest way to remember it is if you need a loan, you need a loanee. So it is loanee.
I love that. I'm going to share my screen real quick because I want you guys to kind of see exactly what we're talking about here and how we're going to do it. So we're going to save between $100 and $600 a month. And we're talking about how if you have a mortgage on your house, you might also have to get private mortgage insurance, PMI. So first, I want you to explain what it's all about, why you need it, and how to get rid of it.
That's right.
Go ahead, James.
All right. So first and foremost, what is PMI? PMI is also known as private mortgage insurance. And what that is it's a special insurance that goes onto your loan that covers the lender in case there's a default. Usually you will only see this on a conventional loan where you are not putting 20% or more as a down payment.
So for example, let me translate. If you were going to buy a house that was worth $300,000, you probably wouldn't have to be required to put down the PMI of if you had 60,000 just sitting in your bank, that 60,000 is 20%. So, but a lot of people don't have $60,000 to put down. Maybe they only had $5,000 to put down. Now you are going to be required to put it down. So let's talk about right. How much is the PMI and how does the bank even determine how much PMI? Like some people are paying more, some people are paying less. So let's talk about that.
Yes. So your PMI can be anywhere from 0.5% to possibly even 2% of your loan amount. And then that's divided by 12. So it's a per month annually. And the bank is going to determine that by a couple of different factors. They're going to look at credit scores. They're going to look at debt to income ratio of the borrower. They're going to look at how many borrowers are on a loan. They're going to look at property type, occupancy. So whether it's a primary residence versus an investment property or a second home. They're going to look at the property type again. So whether it's a single family house or a condo, all of those things go into calculation because the lender is looking at risk. And so they're going to say, okay, well, how many things do you have in your file that create risk in the loan? And the more of those you have, the more the insurance is going to cost.
And just so we're clear, that PMI, just so everyone knows, it's designed to protect your lender in case Correct. Of a default by you, right? Correct. But the benefit is if you don't have the 20% down, then you can be a homeowner faster. If you actually had to wait to save up that money, it's like, no, I don't want to do that because I'm going to get that appreciation, hopefully, in that in between time. So Correct. Now we're going to talk about how to save money. So how do you get rid of PMI?
So there's a couple of different ways we could get rid of the PMI. Obviously, first and foremost is not having it by putting the 20% down. But that's just not the case for a lot of home buyers. 20% down, especially when you're talking like our example earlier of 300,000, 60,000 is a lot of money to have to put down on a property. So to some other ways we could look at getting it done is just making extra payments. So the PMI will fall off automatically when you hit 79% loan to value. So if you just chunk away some extra payments, a half a payment a month, a full payment every month, the more you put down as a payment towards the principal, the quicker you're going to whittle away at the loan balance and get the loan to value to that 79%. It'll automatically fall off at that point. At 80% loan to value, you can request that it be removed. And typically, as long as you've had the loan for at least 6 months and you have a solid payment history with no lates or slow payments or things like that, the lender will go ahead then and remove it for you.
So let's talk about, I've heard that by law, your PMI will be automatically canceled as soon as you have kind of 22% equity in your house.
Correct.
Talk about that a little bit.
So what we're looking at is that's what we were just saying a minute ago. So when you make extra payments on the loan, or not even extra payments, just extra payments will get you there quicker. But when you have a loan to value based on your purchase, where you now have 22% equity, or that 78% equity position, the PMI will automatically fall off. The lender is required by law to automatically remove it once you hit that point. So the quicker you can hit that point, the quicker the PMI will fall off.
Let's talk about an example of $100,000.
Okay.
So let's say that somebody bought the house for $100,000 and they only put $5,000 down. So they've got their monthly PMI in there. What would be the most practical thing that they could do in that case?
So there, in this scenario, they can just make additional payments to get that loan balance down to 78,000. So they have 22% equity. So this is just the first way to get it removed, is getting, making payments to where you get to that 78% mark. So you have 22% equity, and then it'll automatically fall off at that point.
Okay, so now let's talk about asking for a new appraisal for your house. And because right now home prices are rising like crazy, just
Absolutely.
by them not making any payments at all, this could be a really good solution. So let's talk about that.
So the other thing you can do is exactly right, Chantel, as property values increase, you can get to that 22% equity as well. So if you've noticed that there's been for sale signs going up in your neighborhood, and you're kind of tracking what's going on, and you notice, hey, I paid $100,000 for my house, but the house across the street just sold for $120,000. Well, there's a good indication that then the property value in your neighborhood has gone up. So what you can do is you can reach out to the lender, and you can ask them to have a new appraisal done on your property. You typically have to be in the property for 6 months. And again, you have to have a clean payment history, so no late payments on the mortgage. And they will send an appraiser out to do a reappraisal on the property. They're typically going to charge you for this. It's going to be anywhere from $500 to $700, depending on the market and the part of town you're in. But they will charge you for the appraisal. But then if that comes back where, hey, the value of your property is no longer $100,000 where you bought it at, but now the property is $110,000 or $120,000, well, if you have that 20% at that point, then the PMI will be removed as well. If it's not quite there, you may see a reduction in the PMI. So instead of paying $100 a month, it may only be $30 or $40 based on the new loan to value situation.
And depending on where your interest rate is, the fourth way could be that you just cancel your PMI by refinancing your mortgage, because you would then be able to show that you have that equity there. So that's obviously another one. But again, it really depends on your mortgage pay, what your interest rate was. So
correct.
If your interest rate was amazing and you got it super, super low, and now they've increased, you've got to balance that too. Correct. So James, tell people where they can find you and where they can follow you at.
All right. So you can find me at process-mortgage.com. That's my website. All kinds of information about me there. That's also a link to my online application. Or you can reach me at james@process-mortgage.com by email, or you could reach me on my cell phone, 757-404-7756.
All right. Well, we hope you take advantage of this info. See you guys next time. Bye-bye.
Bye.